Hey everybody, this is Eureka John with Eureka Street Crypto Hub. I'm broadcasting in the evening right now. Well, I'm not broadcasting live. I'm re-recording this early morning broadcast I did for episode 200. I did an amazing interview with a guy named Devin, who has been a listener of the show for a while, and he's also a Bankless DAO compadre. And I previously interviewed him before. We talked about digital ID solutions and the UBI token and proof of humanity and all that type of stuff. Amazing guest, and he's a great crypto friend. And I wanted to have him back on for episode 200 and to celebrate this with him and get his perspective a little bit more and pick his brain about his traditional finance background, because he is a former executive in the traditional finance space as in the marketing sector, and he had, could potentially have some really great perspectives, and he did, on the traditional finance industry and their perception of the crypto space, and some of the unspoken things that might go on, or the unspoken perspectives that people in the traditional finance space might have of the crypto space. So it was a really interesting interview. However, this show is all about learning. It's all about making mistakes. It's all about imperfection. And that's what this journey in my crypto space has been. It's just basically a video blog. And I'm obviously not sponsored by anybody or shilling anything, and I say that all the time because I do make a lot of mistakes, and I made a pretty bad technical mistake with this interview in that the audio, even though he could hear me and I could hear him, the audio was not going correctly through the recording. I guess the audio crossed wires when I switched on the Google Meet app to do this interview with versus the OBS broadcasting software, and the audio switched off, so no audio got recorded on my part. But fortunately, I got all his audio, and that's all I really cared about anyway, because he said some amazing things, and I pretty much just kept my mouth shut and listened. So, sometimes a great interview is where you just ask a few questions and you just let them go with a lot of some amazing knowledge drops, and that's exactly what I did. So let's go on through some of these things that he's saying, and I will stop and start and kind of try to give you a rough idea of basically what I had asked him and what inspired his responses here. So let's go ahead and start here. So here we go.
Yeah, well, no, I just say congratulations on episode 200, man. I'm a big fan. I'm really impressed. I asked if I could be on your 200. Thank you for allowing me the honor, because it's really impressive. I went back just clicking around a few different episodes, and the fact that you've got 200, that you have the discipline and diligence to do it every day and advance your learning, that's amazing. So I just find it super impressive that you do it. It's an amazing discipline, and I'm sure it's clear as you do your shows that the knowledge you've got is evolving really rapidly. So it's really cool.
So after that flattery, I started to ask him about his traditional finance background and what he has been able to bring to the crypto space because of his background, and any possible advantages that he might have because of it. And his answer is great here.
Congrats, man. Thanks for having me in. Yeah, it's probably, I'd say what's probably been the best part for me is the experience I have from navigating inside a large matrix organization. So, you mentioned earlier we're compadres in the Bankless DAO. So, the kind of what I'm able to bring to the DAO is some organization, some leadership, some like an ability to embrace the chaos of everything that's happening, try to see through where the opportunities are, and then, elevate the important work for folks to get into. So that's kind of skills that I feel like I've been able to bring from my background as a leader and executive in a TradFi corporation into digital only, decentralized, autonomous organization.
Okay, so real quickly, for those who don't know, DAOs are decentralized autonomous organizations, and right now they are basically an experiment. And corporations and companies have been traditionally top-down hierarchical structures, and DAOs are not top-down hierarchical structures. They're decentralized autonomous organizations in which everybody generally holds tokens, and they get to vote on governance and improvement protocols and things like that in order to better the space. So what he's basically saying is he's coming from this this hierarchical matrix, and he's developed leadership skills and organizational structure skills that he's been able to help bring in and apply to basically what amounts to chaos going on in DAOs as they experiment with how things need to operate in a truly decentralized fashion.
So I think that's one thing that's helped. I think on the finance side, it's what's probably going to be, I'd say, most valuable is that I can translate to folks from the traditional finance world what I learn in decentralized finance and show them the power and the strength and the opportunities there. And then the third thing would be, because my background in digital financial services sort of spanned the top of the marketing funnel to reaching and engaging customers and educating them and helping them on traditional financial services, all the way to, providing the right content and experience to get them to buy products and services. That the funnel's no different in decentralized finance. You just have more, frankly, teaching to do up front and educating to do up front before you can move them down to the purchase step. So I think most of the skills that I was able to employ in traditional finance and Web 2.0 digital sort of constructs and capabilities is all applicable to decentralized finance. Less the learning curve I have myself, like you said, regardless of what your background is, it's a highly technical space. So because I don't have the development background, got to lean a lot on technical people to explain concepts and things. But what I love about like the communities that we operate in, that like second to none, is that a desire to support, educate, and learn. So I find people so forthcoming with information, so patient with teaching. Everyone seems to enjoy it. So it's pretty cool that way. So it's a tough barrier though. Like when you don't have the knowledge, it can be intimidating. But know that, as you discovered and I've discovered, that the communities are there to support the growth and learn.
Yeah, because another point that I prompted him with this question was saying that people have either a finance background or a programming background, or they're just average schmoes like me who don't really have either finance or programming background and just kind of jumped into the space. So everything is kind of a blank slate right now, and everybody's just trying to figure out what type of skills they can bring into the situation.
Yeah, I think I'd say, if you're talking about like financial product.
Okay, and here we start talking about innovation in the space, and a lot of banking institutional people that work for banks. They get their finance degree, they get their business degree, and they move up through the ranks, and they stay within that traditional structure. There's not a lot of room for innovation, and he explains some of this that goes on in there, and where, if at all, DeFi and crypto could fit into this space. And so go ahead and listen here. It's amazing.
Development. Yeah, traditional finance has been, I don't think they know that they have well, they might know, but the point is that the infrastructure has not really allowed them to innovate, right? Because they're just sitting on a legacy financial system that does what it does. It is the amount of investment that's gone into regulating it, right? Remember, regulating it means people, process, and technology dropped on top, okay? So the entire financial system is regulated by people, process, and technology. That innovating on top of it sucks. So, as much as you've got governments, right? Like in Canada, for example, we have the big five, so a pretty concentrated banking system. Some argue the big five have the monopoly. There's lower tier banks, but there's nowhere near the number of banks that you have in the U.S. So, our government has tried to open it up and allow for more competition and everything, which is great. But the construct, the paradigm in which financial services are delivered is kind of already set. The expectations are set. So there's not a lot of the new entrants are coming in just trying to take share from the big banks that are, already doing what they're doing. There's not a lot of innovation. So in the fintechs in the space, they're really I call them partner fintechs. So they're building up to get bank money, right? They want to build up fintech capabilities, partner with banks because the banks have a ton of money. So then you've got decentralized finance, which is saying, probably, in my mind, decentralized finance said, look, we get it. You cannot change that existing system. It's pointless. Start a new one. And it turned out to be right. Like Pandora's out of the box and the new, the blockchain, the ledger and everything that was invented there now enables a decentralized finance system that can operate on its own. It's probably the right place to innovate in on top of. So if I look, part of what I want to do, because I've left the bank now and I'm fully doing my own thing, and part of what I want to do is help banks see the power of the technology and start to think about how to use it and embrace it, right? There's different ways for them to get involved, right? So, if you think about KYC, for example, you and I have talked about that from an identity perspective and the ability to get maybe some new fair lending practices, right? And so imagine you're a bank and you create a lower cost lending process and you build a KYC process on top of the chain that you're comfortable with, and you automate, and you use liquidity protocols, capital efficiency models that you learn about in DeFi. Hell, copy and paste the code, bank. You know what? Nobody's telling. It's permissionless. No, everyone expects you to do something. Do it. Drop it. Use the fact that you can do, and then take on the market. Right? There's just a ton of opportunity, in my opinion, for banks to get involved, particularly with bridging the physical world with the on-chain world, here's a great example, right? Banks spend billions on KYC processes to open accounts. And all they're doing is mimicate what we have in our Web3 wallets, which is an authenticated service. So imagine a Web3 wallet evolved and it had cryptographically stored information about you. And then the application, the account opening process would simply be the bank reading the elements of the wallet that they need cryptographically. They need to pull some information, right? Allow it to happen. So rather than building your own $100 million account opening process in the Web3 world, account opening is instant with wallet signatures. So there's just so much tech that the banks can learn from to improve the experience, which hasn't really been improved since they invented online banking. It is the same. So there's just innovating on top of the legacy systems, forget it. Rebuilding your banks with the current infrastructure, don't even bother, because it's terrible anyway. So, in my view, it's hey, the banks that are going to win are going to be looking at the alternative web here and saying, how can I use it, right? That would be.
Yeah, right here is I believe I went into a little thing where I talked about how banks are going to basically have to be small businesses again, and like in the old towns of the Wild West, where you have to trust the person in that bank, and with the bank vault in the Wild West town to lock up your money, and they have to serve the customer once again instead of the customer having to comply with everything that all the banks demand. So banks once again have to actually think about the customer.
Yeah, I mean that. Yeah, they do need reinvention, right? They're just capital monsters that have. It's partly the regulations that force them to that kind of keep them right. Like they have to keep their ratios at a certain level in order to operate as a financial institution. So yeah, it's and the way they make money, right? The way they make money, it's just it's repetitive, and it doesn't allow for a certain amount of innovation, right? Yeah. So I mean, it's
Okay, and here I start to talk about NSF fees and how all the fees and the fines, the $35 NSF fees, asking where they come up with that $35 fee, all the nickel and diming that the banks are doing to people and how they make money.
it's primarily lending, right? They take our money, they lend it out, and they have margin on the rates that they pay us. Yeah, they have them. Yeah, it's a massive. I never really got, like, most of what I did was in the consumer facing digital banking side, so I was never involved in the kind of technology that operated the treasuries and stuff. So, but my understanding of the legacy technologies that operate those are largely liquidity systems.
Oh yeah. Before I asked him about the NSF fees and all that stuff, I asked him about the fractional reserve banking and how basically banks make money by lending out 90% of people's deposits and only have to keep 10% in the bank, and then how they make money doing that.
Yeah, what those ratios are, I'm not sure, but yeah, there's certainly that. Oh yes, yeah, I see. Yeah, yeah, arbitration, and the tools they have to facilitate their liquidity and the how they invest our funds to make more funds, how their lending processes. It is a significant system that they own and operate. And like I said, the biggest thing that, like, to me, the biggest barrier entry to banking is compliance. Like, it costs so much money to comply with federal regulations that it is probably one of the major barriers to entry. Because if you imagine somebody said, okay, I'm going to build a bank from the ground up, and it's been done. But it is the cost is not necessarily in building up the financial systems to do it. You're plugging into existing legacy systems, but it is the regulatory and compliance activities that can be very difficult to manage and operate legally as a bank. So probably another reason, again, why decentralized finance is permissionless. Well, I haven't even mentioned interchange yet. Oh man! So every debit or
Here's where I start talking about the fees.
Credit transaction, there is a transaction fee called interchange. It is for the pleasure of using their ancient rails. So every time you make a so obviously the banks make a lot of money if you carry a balance on your credit card and your debit facilities, because you're paying them interest. It's great, but for credit card transactions, they want you transacting because they take a rate off they take a piece. So they're like the government with sales tax, man. The more we've gone to online payments, obviously in Canada, debit card rails are highly efficient. Like Visa debit isn't that popular here because we have our own, it's called Interact debit system. The interchange on debit transactions is much cheaper, but the Visa and MasterCard global transaction networks, they take a little chunk of every single transaction. So And then global remittance. Oh, that's a puke fest, right? Like I think that's well known, arguably predatory global money movement, right? Like it's terrible. So you imagine, and more, I guarantee more profit than everyone thinks in a bank comes from their credit card offering. Yeah. So when they look at when global remit or payments, right? Like I remember being at the bank 15 years ago when PayPal came out, we were freaking out. Like, oh my gosh, PayPal's going to eat our lunch, right? And wait a minute, they're acting as a merchant. They're paying our transaction fees. Why would they do that? Oh, they want to build a closed loop so that the every cash is in there. Like to me, that was the first invention of how crypto would manifest. Take the money to the bank, put it in the closed loop payment system, and off you go. That's PayPal's dream, right? Have all the money in our closed loop system so we don't pay interchange. We just charge interchange. Then you fast forward and you got DeFi now. It's like, okay, atomic transaction, no double spend, instant, person to person, trustless machines. So now you don't need any of that garbage that works poorly. You don't need the rails. You don't need to pay interchange unnecessarily, right? Because you're not paying for securitization of the network. They haven't innovated on securing the network in years. So, like in the interfaces like are a joke. Like there's no innovative experience. So yeah, DeFi is like saying, hey, we don't charge interchange. We charge you gas fees. What do gas fees do? Secure the bloody network, right? There's value in the transactions. It's not to put the money in the bank of the shareholders. It's to pay to securitize the blockchain for the community that used it. Like that's a reason to pay a fee.
Yeah, right here. I mean, basically what he's saying is in DeFi, the community are paying the fees. And obviously there's been some issues with Ethereum and the high gas fees lately, but the community wants to pay those fees so the network is continually secured. It is community participation in those fees. And then you can also get money from those fees if you are a liquidity provider or a stakeholder. A stakeholder. And I mean, so everybody gets to benefit from it, and it doesn't just line the pockets of the bankers. So this is great.
So it would be, who thinks up the number is like my buddy down the hall.
Oh yeah. Here's where I was like, okay, where does this $35 NSF fee come from? Because I was talking about how yes, I do have money into crypto, but my day-to-day checking account, I'm terrible at balancing all that stuff. So I'm getting nickel and dime to death with fees. I'm going to the gas pumps and having my card shut off on me. There's just rampant abuse by the banks of just the general public. I'm having some kind of revolving subscription that I forgot about might pop through and throw off my balance. And I mean, it's sometimes, even especially nowadays with a lot of these automated fees and fines and things popping through, it just seems like it's a full-time job just to even keep a balance of your account. And then the banks are definitely taking full advantage of this. Anyway, I asked him, I was like, who are these people that are deciding that it's $35 is what an NSF fee should cost?
Owns the P&L, the profit and loss.
Reverse this just a little bit. Okay.
So it would be, who thinks up the number is like my buddy down the hall, who owns the P&L, the profit and loss for that account. And when they need to make more money, do you think it usually comes in the middle of the year? Okay, like, hey, you need to make more money next year on that. Okay, you don't have time to innovate, nor are you likely going to get a budget to innovate. So what do? What's the product manager's only lever? Take money. They take money from marketing. It's like, hey, I've got to reduce my expenses to increase my thing. So I can't spend as much on the marketing this year. That's the first thing they do. And then they go raise the fees. or they or they look at the model and they adjust the pricing to shape a new revenue model that's slightly higher than the old one. And then they put a whole communication together and customers like, what is this? Where am I landing? Okay, better for me, worse for me, not sure. I don't have time for this. And now all of a sudden they're making 10% more on the P&L, and all they've done is change the pricing. So it's quite innocent as it happens. It's just like, you've got this leadership group that, is answering to the board and the shareholders, and it's largely a revenue story. What are we making in reducing expenses and all that? And it's quite a big divide from, what's happening on the front line with the customers, right? So it's like, we need to generate X or reduce Y. That goes to the teams that own those P&Ls, and then we figure it out as quickly as we can.
So right here, I made a comment at some point about how everything is compartmentalized, and I also draw an analogy in large government structures with, weapons of mass destruction. The people that make these weapons of mass destruction aren't necessarily the people that are implementing them. They're just doing their own little compartmentalized part, and that's kind of the way I see it here, with these people making up these fees and these fines, making it really difficult on, say, Juanita, who needs to send money home to the Philippines. And then all these fees and fines taking about, a huge chunk of that amount that she's trying to send home, and making it very difficult for people who are trying to make ends meet every single day. And so the people actually implementing these policies aren't necessarily evil and bad. It's just they're compartmentalized, and so they haven't really been able to have any choice aside from basically answering the needs of their immediate superiors and keep their job. So
banks just aren't really they aren't looking to change. Or we're kind of like, we don't know either, right? Like, we don't know that there's a better system. So when you're in it, you're just promoting the best system out there that's slightly better than the competitor that's not really competitive. So you're just trying to, like, the battle becomes, can I out-service, out-smile, out-message, outsmart my competitor, right? We're not really competing on product innovation. We're tweaking price, we're tweaking message, but the underlying financial system is so highly regulated, it's the same. There's the banks aren't really trying to out-innovate. They're really trying to out-acquire, out-engage, out-service an existing customer bank that is highly dependent on a banking industry. So, I think there's lots of those types of things that kind of prevent, because I know inside the bank, it's like really smart people that want to do really, really cool stuff. It's just that, the systems and process don't allow it to happen in any spectacular rate, speed. Yeah, I think you're describing a bit of a there's might be a bit of a willful blindness in there, right? Like we're just focused on getting the job done, not really thinking about whether or not we're making anything better. Yeah. We're promoting them in the newsletter, and we're gonna partner with them on a couple.
Okay, here
project
is where I started talking about the Bankless DAO's partnership with UMA protocol. And I have him explain a little bit what UMA is, because I was kind of unclear. I thought that UMA was specifically a competitor to Synthetics, which is a derivatives trading platform, a DeFi, a decentralized derivatives trading platform. But UMA is a little more in depth than that. It is a protocol that helps people create derivatives finance platforms. And the decentralized derivatives finance platform. So I'll let him say it. He says it better than me.
Hopefully, I'm hoping we do some DeFi projects too, but we're definitely going to look at the marketing metrics piece. They sound like a dev platform. Yeah, definitely derivatives, but it sounds like more like a development platform. So they would be targeting developers who would want to build financial DeFi products quick and fast on their architecture. That's how I'm understanding understanding them. So, when Iced Cool was there from our dev guild on the call, you heard him get pretty excited about what they could possibly be building on it. So yeah, it seemed to me like a dev toolkit for building decentralized finance products. And that's how, they had sent one over to us. Did you see there? Yeah, it seemed like a dev toolkit. So it would be some sort of so that what they would do is program some key functions in smart contracts that do certain basic things. And then they provide a developer toolkit, I assume, that allows, developers to call on those really complex functions without having to code them.
Yeah, so basically, UMA is creating protocols that other projects or companies could be able to use and put their own skins on top of and interfaces on top of the UMA protocol for decentralized derivatives. And we started getting tried to almost go a little bit deeper into the technical weeds, but yeah, we both agree that that's well above our pay grade at this moment. So we just tried to only get the concepts down.
So it's basically you get some advanced sort of financial contracts, if you will, baked, coded, and then you kind of can call on those in your dev. So yeah, and then and they've launched another company. I'm trying to find a link for it. Another organization built a sort of synthetics copycat competitor, if you will, on top of their platform. I'll find you the link for that. So then the question is, you could say, well, how do people make money then? Right? Where's the money come from if it's not the actual asset? If you're not trading the actual underlying equity or asset, what's going on?
Okay, so right before this question, I asked him what is synthetic is, and he kind of put the ball in my court to explain that. So I'll do a quick explainer. A synthetic is something that is not the actual asset. So you don't own the actual asset, but it's something that is pegged to the value of another asset. And I brought up an analogy of a NASCAR race. And if you watch NASCAR on TV, you see that little box that is pinned to each specific car, and it has the driver name, the driver information, the speed at which they're going, the RPMs a lot of times, and whatever, any other information. Well, the synthetic is what is pegged to that. So all that information that is in that little box and tracking that car, that is the synthetic. So whenever you buy a synthetic, you are buying the information pegged to, say, gold, silver, any type of stocks or index fund, Facebook, Apple, Amazon, Netflix, Google, the FANG stocks, and you are buying the value that is pegged to that, but you aren't actually buying the actual asset.
So all these guys are making markets, right? So, and the reason these guys are creating these derivative markets or option markets or leverage whatever you want to call them, is because they're so efficiently just building the market. So as long as you have two people on either side of the trade, you can have that derivative market. It's just people that have put it's a gambling pool. Let's be realistic, right? You don't own the asset, nobody does. You're betting against each other. Whether that's good or bad, I can't say. They're certainly fun. Right? And the guys that are good at it make the money. Right? And that's where you get market makers in the traditional finance system. You can't help but doing it, because all you're doing is you're following a pattern that makes money. You ignore the fact that you're the market maker. When you do X, Y, and Z, that happens. You're not smart. You're not predicting it happening. You're a cause of it. So, there's real temptation to make very inappropriate money in these markets. So that's another story. But I'll share with you this window. So this was built on.
So he's going to show the interface.
If I share my screen, let's see what it looks like.
That another protocol is using. Is using the UMA protocol.
So this was built on UMA. It's tracking stocks. So it tracks the top 10 stocks chosen by Wall Street Bets community. So what these guys in Yam Synths have done is they took the toolkit from UMA, right? Like UMA tracks the stocks in the top 10, and then this Yam Synths company has built this U stocks market so you can trade in this market, right? And it just tracks, that's it. So the UMA is doing the tracking of the value of stonks, and YamSynth is using their platform to enable this market, would be my understanding of how it works. Yeah. I think that's what you would build. Well, I think that's what you have to build on top of their platform. They may very well have like, pre-coded applets or components or whatever they're called.
Yeah, and this is where I brought about the idea that they're basically creating character skins or just application skins almost, and then just using UMA as the underlying framework protocol. And so anybody, any company or product or protocol or decentralized protocol or whatever could use UMA as their underlying infrastructure.
For that, but I think that would be something you build into your system on top of it. Yeah, me too. I try and like visit the dev guys' talks once in a while and let it absorb. It actually helps. It's kind of how I came to learn that what Solidity was just sitting on it, listening to some devs talk about Solidity, and I'm like, oh, it's a language. Yeah, cool. So yeah, but one other thing I'll tell you at margin, which you'll find interesting, that's different in the TradFi to the DeFi world, right? So in the traditional finance world, do you know what margin is? Margin, yeah, trading on margin.
No, I don't.
Okay, so it's kind of like it's like leverage trading, right? So say I own $100,000 in a set of securities. Similarly to collateralizing your loan, it's called margin in a brokerage account. Let's say, okay, great, Devin, I'll lend you up to 60%. Right? So you margin 60% of your $100,000 holdings to trade, and you can buy other stocks and things, right? So it's similar to collateralizing a loan on Aave or something and then buying a security off of that collateralized loan. So you buy other securities in the account. The thing is, when you do margin on a brokerage account in traditional finance, your entire book is collateralizing any shorts or longs or anything, any risk you're taking, okay? Therefore, your whole portfolio can be liquidated to pay the broker back for trades that go south. In D-finance, like what were we talking about earlier, XY, AY, BY, XY, what was that? The DX?
DYDX.
I got it backward. DYDX, right? When they're doing like margin positions, they're just taking the two sides, right? So they're securing the other side of their trade with somebody who's taking a counter position to you. So when you trade on margin in DeFi, you only risk the position. They don't hold your whole portfolio as collateral to the one account. They simply say, no, the one position's at risk. You've collateralized against it so that you could leverage 3 times and buy more. But if you don't maintain that health ratio, we will liquidate and take our money back. So the program decides when it's appropriate for the liquidation to happen for both parties to get their money out. Now, it is kind of cold because it's not like you can call and say, give me 10 minutes. I'll get the money together. Like there's not a broker on the other side you can negotiate with. It's a machine, right? But a machine's doing its job so that it doesn't have to, hold your entire account collateral to the one trade, right? If you've taken a risk on one position, somebody on the other side is taking the other side. So settlement is very different in that respect. And it's really about, these developers understanding finance or working with finance people to make just exponentially more capitally efficient systems. And that's what we see every day in DeFi. It's just like they just keep cranking out capital efficiency that eventually TradFi is going to have to take notice. I mean, like between chains? Yeah. Yeah, we'll get it all, I think that's the importance of the education
well.
we're involved with, like you and I both.
And I mentioned, the possibility of, in DeFi summer, last year, there was a lot of exploits and exchange hacks and Oracle exploits and things like that, as, devs were trying to create financial products without necessarily knowing finance. So that did open up the door to a lot of attacks and hacks and things like that and exploits. And then I said, well, maybe this year we're dealing with interoperability issues, and we're trying to make a bunch of different blockchains interoperable with one another. And once again, I think that there will probably be some more hacks and exploits popping up as interoperability becomes a key issue.
Hang out with Defiant and Bankless, because it's so important to educate yourself on these things. Like, I started educating myself on the cold storage wallets to be like, okay, what's the next level of security? Wow, these cold storage wallets, phenomenal. Do you use them? Use a cold storage wallet? Yeah?
I said, I got a little nug in cold
right,
storage.
Yeah, that's what I need. Well, at least you got one. At least you're thinking of it. I just kind of keep everything hot. But I'll deposit some things into different accounts so that, it can't really be touched by the wallet. But yeah, exactly. Like,
I spread it out through a lot of different
I just think
wallets.
It's cool to be able to say, I took it off the internet. Yeah, no matter what happens, I got it. Awesome. My pleasure, Ben.
So that was the interview, and I really appreciate Devin's time for this, and having a guy of his caliber being able to explain to people that barely know anything about finance in coherent, easy to understand terms is absolutely valuable, and I will treasure this interview for the rest of my life. And I really appreciate this. So this was an amazing morning, and I'm just my only regret is not getting the audio completely correct the way it should have been, and not being able to show you the organic nice flow that the conversation had. It was an invaluable conversation. So, but either way, whatever, I got what I wanted to get, which is all the nuggets of knowledge that Devin could provide, and I appreciate his time. So I'm going to go to bed now with this episode complete and under wraps, and I will upload this and enjoy. All right, take care and good night.